Live from Bloomberg's brand new Mumbai studio, this is Insight with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. U.S. Treasury Secretary Scott Bessent tells Bloomberg that he favors a strong dollar and has no plans to tinker with U.S. government debt plans, showing a cautious approach toward financial markets. A moment of calm for investors ahead of U.S. jobs data later today. As focus briefly leaves the drama over tariffs, a weak print could boost expectations for further Fed rate cuts. Meanwhile, India's new central bank governor, Sanjay Malhotra, is expected to deliver a 25 basis point cut in his first policy meeting. Traders also watching out for his comments on the rupee. And we'll discuss whether a rate cut is needed to spur spending with the chairperson of one of India's top consumer-focused companies. Nadir Godrej joins us this hour for an exclusive interview. Well, muted trading action here in Asia, not surprising given the trepidation ahead of the U.S. jobs data. That may just dictate where the Fed goes from here. Might it cut rates, raise rates, even if the number comes in pretty aggressive? The number we're looking out for, 170,000 to about 200,000. If that number comes within that, perhaps the market will be able to absorb all of that and stand pat. MSCI Asia Pac Index currently up by about 1/10 of 1%. We're seeing big gains in the CSI 300 index as well as the Hang Seng index, now up by about 1%. It is about tech. Remember, it is about DeepSeek. Perhaps raising sentiment in the market there. We could see a reversal for the tech plays. Also, when it comes to the property sector, expectations of more stimulus to revive that sector. In terms of the Chinese yuan trading at 729, it is the Japanese yen that we're also keeping an eye on, breaching 151, currently 151.59 versus the USD. Now, investors are also keeping a very close eye on any hints of policy shifts from new U.S. Treasury Secretary Scott Bessent and other members of Trump's administration. But Bessent told Bloomberg he has no plans at the moment to adjust policies on dollar strength or debt issuance.
First of all, the strong dollar policy is completely intact with President Trump. And I was very happy at his Economic Club of New York speech in August when he reemphasized the importance of maintaining the dollar reserve currency status. But let's think about, what does a strong dollar mean? It really means four things. One, that when we think about a fiat currency, a piece of paper is credibility. So a strong dollar is credibility and a rule of law that is backing it up. Two, it means a composite price on the screen, the Bloomberg Currency Index, that is the dollar moving up against that. Three, it is a bilateral price. So what's important to remember is the dollar is either weak or strong versus something else. So we want the dollar to be strong. What we don't want is other countries to weaken their currencies to manipulate their trade. And then fourth, that we want to have the best policies that create the environment for a strong dollar.
Let's talk about other nations and how they manage their currencies. The president has asked for a tariff study from several of his cabinet officers or incoming cabinet officers due April 1st. And the Treasury piece of that is to assess how to handle when foreign nations manipulate their currencies. Do you see any evidence of manipulation in foreign exchange rate markets right now?
Well, we'll wait till the study comes out, but I think just intuitively, you and I could agree that when you see the accumulation of these large surpluses, that there is not a free-form trading system that's going. It could be due to the level of the currency. It could be due to trade restrictions. It It could be due to some interest rate repression policy. So it could be any of those.
Yesterday, the Treasury Department had its first quarterly refunding since you were confirmed. Do you have any plans of looking at how the Treasury's debt issuance strategy comes together?
Well, I think the good news is that the trajectory of the borrowing is dropping. So I was very happy to see that it's one of the few good surprises I was left by the previous administration. So the trajectory is good, and the government's well-financed into the third quarter, and I believe that as it becomes apparent that the president's agenda is working, that we'll see a great deal of non-inflationary growth. And I think that will help us calibrate what the debt policy should be. But I don't foresee any changes in the issuance for the foreseeable future.
Mr. Secretary, I want to ask you if you have had your traditional weekly meeting with Fed Chair Powell yet.
We did. I did an away game over at the Fed. We had a very nice breakfast. Chair Powell and I don't know each other well, so it was very constructive. How
do you view that relationship evolving? The two agencies and buildings are supposed to work very closely together, and you've had some criticism in the past of his work.
And as I said at my hearing, everything I'm going to talk about is things the Fed's done in the past. Prospectively, monetary policy, I will not comment on, and I'm sure he's going to do the right thing, so there'll be no criticism.
And that was U.S. Treasury Secretary Scott Bessent speaking with Bloomberg's Saleha Mohsin. Let's get insights, perspective. Let's get more on the markets with Aaron Costello, head of Asia at Cambridge Associates, a global investment firm with over $500 billion in assets under management. Aaron, good to have you with us. First off, he said he favors a strong dollar. It is a double-edged sword. How do you see this playing out in markets?
Thank you, Haslinda. I mean, I think by nature, the Trump administration policies are a bit contradictory. Yes, they've come out and said they favor a strong dollar, and tariffs tend to put upward pressure on currencies, but they've also said the long-term goal is to build the U.S. industrial base and manufacturing base and boost U.S. exports, which you need a weak currency for, and President Trump has in different times said he wants a strong currency or a weak currency. So I think the bigger picture here, honestly, for the U.S. dollar is, in the short term, it's about tariffs. When are tariffs coming? I think the markets are breathing a sigh of relief at the moment, but we're actually not out of the woods yet related to tariffs. The tariffs for Mexico and Canada have been delayed. China's in discussion. There's been no talk of the Eurozone current tariffs yet, let alone discussion of this universal tariff that Trump talked about on the campaign trail, which has been muted to be from 2% to 10%. And so I think tariffs are coming. We should not be lulled into a false sense of security. And so again, the ongoing threat of that needs to be there. I think the good news about tariffs, though, is that it's clear the Trump administration is going to use tariffs as a negotiating tool. And so I think while that may create more uncertainty, I think it also helps take off the worst case scenarios related to tariffs, particularly related to China. I think a willingness to negotiate reduces the odds of a 60% tariff being put on Chinese goods. And I think fundamentally that's good for Asian markets. But again, we still don't have clarity on that. And I think the tariff story is not done, and we shouldn't be kind of celebrating prematurely on that regard.
Tariff story not done, but tariffs are coming, whether it's 10, whether it's 60%, Aaron, yet you expect the dollar to weaken from here. I mean, tariffs will be inflationary.
Yes, I mean, again, tariffs are also a double-edged sword. They can be inflationary in the short term, or they can also be a hit to growth. I think fundamentally what's going to drive the dollar is actually Fed policy and the strength of the U.S. economy. And I think that gets into the jobs number later today that you were talking about before the break. I mean, fundamentally, the dollar has already rallied a lot on expectations of tariffs, on expectations of higher rates, et cetera. So a lot is already priced in. The U.S. dollar is extremely expensive on any kind of traditional currency valuation metric. And again, a lot is priced in. So if tariffs are, while coming, are lower than expected, and if U.S. growth continues to modestly slow and the Fed ends up cutting rates in the second half of the year, you could see the dollar weaken from here, or at least be flat for the rest of the year, which is kind of our view. Now, it's not a high conviction view because it depends on a lot of the tariff policies, let alone the tax policies. that haven't come out yet. But fundamentally, if the U.S. economy modestly slows and the Fed does cut rates, you should see the dollar start to weaken.
So all eyes on the jobs data today, 170,000 to about 200,000. They say if it is within that range, the market will be able to absorb that. What are you looking at, and what are you looking to extrapolate?
Look, the monthly jobs number has a lot of volatility in the data itself. It's a very noisy number. And so I think what's most important with this data release this Friday, later today, is actually the revisions. So this is the January data release where they will revise all the numbers for 2024. And preliminary estimates were that they may revise the jobs numbers down by 800,000 jobs last year, which implies that the U.S. labor market isn't as strong as some people may think. And so I think the Fed's going to actually anchor more on that because it's going to give a better underlying indicator of the health of the labor market. So if you had the very large downward revisions and the jobs number disappoint, I mean, you could see bond yields rally on that because that implies the labor market isn't as strong as people anticipated. The opposite is also the case. If the revisions are less than expected and the number blows out above 200, you would see upward pressure on yields, potentially, because that means the Fed may have to hike later in the year. So I think this is a very important jobs number. I think there's a lot of noise on the monthly number. The revisions are what we should be looking at. I think that's what the Fed is more focused on.
And all happening against a backdrop of rising uncertainty with the tariffs that we've been talking about. I mean, how do you navigate this kind of environment? What's noise and what's not? And vol obviously is the new talk of the town, is the new normal.
Look, I think the way you navigate this environment is by taking a longer-term picture. And yes, the tariffs are important, the policies are important, but in this kind of vacuum period here where the policies aren't clearly articulated or are changing, you have to go back to fundamentals of valuations and earnings growth and economic growth. And so I think at this point in time, it's hard to have very high conviction views. We anchor to a longer-term approach. We look at valuations, and so our view today is the U.S. market is expensive. The technology stocks are expensive. You have record concentration in U.S. equities, and so we want to tilt away from that modestly. We want to be overweight value. We want to be overweight small caps, both in the U.S. and globally. But we don't want to take very large positions on what the tariffs may or may not be, on what the tax policies may or may not be, because it's all in flux. And ultimately, over the long term, the fundamentals should prevail: valuations and earnings growth.
Speaking of earnings and valuations, let's talk about the Mag 7. Pretty much a beat, but when it comes to sales, they disappointed the likes of Amazon, Microsoft, saying that, you know what, they just cannot meet the demand. How do you play the Mag 7? Given that they're already really expensive, do you still buy the dip if there is a dip?
I mean, look, we're not short-term traders here. I think, as I just said, we want to tilt our portfolios towards value, towards small caps. Now, it's not a large tilt. I think you want to have exposure to these companies, but the market is extremely concentrated in these names. In fact, I would argue the single largest market risk there is the Mag 7 because of the weight it has in the U.S. indices and in global indices. And so if anything rolls over in these stocks, the U.S. markets will roll over. And so we want to be diversified and slightly tilted away from that. I think the whole DeepSeek announcement does show that maybe you don't need to spend as much. And as these companies continue to spend on AI, that may hurt their profitability in the short term. And I think that's what the market needs to digest right now. And just given the large valuation and arguably the concentration in these names, we want to be more defensive and more diversified into cheaper parts of the market.
And DeepSeek has given a lift to AI-related shares in China. Would you be a buyer of those tech stocks in China?
So in general, we are neutral on China, which, is given that most people are negative and most funds are underweight China. I think being neutral and constructive on China is still a contrarian view. I think Chinese valuations are attractive. And the reality, uncertainty in China is this drag on growth from the real estate sector and deflation. Right? So the biggest issue in China is really the deflation. I think the Chinese government has made clear that they are going to deliver enough stimulus this year to support the economy, regardless of where the tariffs land. And I think that fundamentally, we should not be expecting a collapse in Chinese growth or collapse in Chinese equities. But for Chinese equities to really outperform, we need to see alleviation of the deflation pressures in China. And we haven't seen that yet. And so the market is still kind of stuck in limbo as the government needs to roll out further stimulus measures and the lack of clarity on tariffs. But as I said earlier, if Trump is willing to negotiate with China, the threat of 60% tariffs is probably reduced. And if China does come out and announce larger policy measures at the two big meetings in March, where they typically announce government priorities for the year, you could see a rebound in Chinese growth in Chinese equities. And we want to participate in that. We don't want to be underweight China. Again, I think Trump wants to negotiate with China. They want to negotiate over TikTok. They want to negotiate over China's influence on Russia for the Russia-Ukraine war. And so I think there's a lot of things in play that if the Trump administration is willing to negotiate, I think China is also willing to negotiate. And so that does create some potential upside for Chinese markets.
Oh, the thing is, Aaron, even a 10% tariff in China will hurt an economy that's reeling and struggling to recover. This is not the same China as 5-10 years ago. The fundamentals are different. So even a 10% tariff might just, cause a dent in the Chinese economy.
Yes, I mean, for sure, the Chinese economy has become more reliant on trade recently as the domestic consumption has been weaker. But I think that's well understood, and the market also is expecting Chinese growth to slow. But I think if it's a 10% tariff is put on China, but 25% is put on elsewhere, or even there's a universal 10% tariff put on other markets, net China's competitiveness has not changed, and China still is extremely competitive on the export side. And so the real issue in China is actually domestic sentiment and the deflationary pressures. And if they can reflate the economy and domestic demand pick up and domestic inflation pick up, that's much larger than the export sector, and that can actually drive or stabilize the economy.
Aaron, let's talk about Japan. The BOJ expected to raise rates. How do you play the Japanese market?
So, I mean, in general, we're also neutral on Japan, although slightly overweight if you overweight value. That's implicit in that is a Japan overweight. I think for Japan, look, the inflation dynamic is real, and the BOJ will likely be raising rates further this year, and that should help support the yen to some extent. But I do think that actually the large cap stocks in Japan are a little bit expensive. And also the large cap stocks in Japan are pretty export oriented. And so a strengthening yen should actually dent their earnings growth. We prefer to play the Japan market, and especially the Japan reform theme, through small cap stocks, which we think are cheap relative to the broader market and are also less sensitive to the yen strength, but also in the private equity buyout space. I think that's a more pure play way for investors to play this corporate governance theme, this kind of the consolidation that's going on in the market, the M&A boom that's kind of taking place in Japan. And so that's where we've been allocating client capitals increasingly on the private equity side in Japan. And then among Japanese equities, it's more the activist and small cap strategies, which will also benefit from the reform theme.
Given that Japan is on the cusp of raising rates, do you see perhaps this is the moment when Japanese funds pull their money out of the U.S. perhaps and put it back home?
I mean, that's been an ongoing concern, the amount of Japanese capital that's invested overseas coming back home. I think it's more about the bond yields rising, because I think Japanese outbound equity investment is relatively small. It's Japanese capital is large owners of U.S. Treasuries. Actually, they're the largest owner of U.S. Treasuries, according to the Treasury data. And so there is a risk there. And so the question is, how well does the BOJ navigate this? But I mean, from the fundamental perspective, I still think the bigger driver of U.S. Treasury yields is not going to be Japan selling. It's going to be more the Fed hiking or the Fed cutting rates and the slowing U.S. economy. So I think, what's going to drive the Treasury market is that, not, Japanese repatriation.
Aaron, before we let you go, I'm coming to you live from our new Mumbai studio. And of course, the RBI set to cut rates after 2 years of keeping it standing pat. I'm just wondering what your thoughts are. Do you see funds coming back into India? Here, of course, we're referring to foreign funds.
I mean, I think, first and foremost, India, given the slowdown in the Indian economy, a rate cutting cycle needs to start, but I think they need to be cautious. So I think the 25 basis points is more realistic, because if they cut more than that, that's going to put more downward pressure on the rupee. And given that headline inflation in India is still near the upper end of the RBI's target of 5 to 6%, inflation's at 5%, the target is 6%, downward pressure on the rupee can further increase inflation. So I think there's a balancing act the RBI has to follow. Also, the RBI has been defending the rupee. It's actually been quite stable relative to other emerging market currencies, but you're actually seeing the FX reserves in India falling. So I think they need to tread carefully here. But a rate cutting cycle, I think, is justified, especially as the Indian economy is slowing. Regarding international funds, I think the real story in India is that this big rally in Indian equities has been driven by domestic Indian investors. Foreigners have actually been net sellers for a while now in India because the valuations are so expensive. And so I think a lot of foreign investors are somewhat reluctant to chase the Indian market because the valuations are very high, even relative to India's own history. And so given the combination of slowing growth in India, a weakening market, and also the budget that's been announced, net is still cutting government spending, which is, I would still think, net a drag on growth. I think foreign investors remain short-term cautious on India, but long-term optimistic.
The much anticipated new central bank governor's speech today. Aaron Costello of Cambridge Associates, thank you so much for your time today. Now, still ahead this hour, Godrej Industries Chair Nadir Godrej joins us exclusively to discuss India's consumption trends and his thoughts on the Modi government's latest budget. Keep it here with us. This is Bloomberg. Bank of Korea Governor Rhee Chang-yong is pushing back against mounting speculation of a rate cut later this month. He told us exclusively that further fiscal stimulus is needed to support the economy.
So when and how much, we will look at all other elements. But definitely we think that monetary policy and fiscal policy both have a room to have a more accommodative monetary policies.
Especially now that you have seen a few weeks of the Trump presidency and all of these tariff threats coming into place.
Right. So that is why I'm emphasizing more fiscal stimulus is necessary. First of all, we in the last 2 years, when we have a very high inflation period, unlike other countries' government, our Ministry of Finance maintained a very conservative fiscal policy. So in some sense, we have more fiscal resources when the economy is now heading below the potential growth rate. So we have room. And second, monetary policy has room to cut because our current interest rate is a slightly higher in a restrictive area. But on the other hand, as you mentioned, even U.S. policies and U.S. Fed policies, the depreciation pressure is building up. So in monetary policy, we have to consider both the stimulus effect as well as its impact on other exchange and other areas too. So that is why I think a policy coordination between fiscal and monetary policy is very necessary at this moment.
Why not make a move now when potentially the effects and fallout of all of these different risks from the domestic and external factors could come in at some point later in the year?
Actually, I think this is a criticism that I got a lot in domestically these days. Why you are not cutting interest rate more actively? I think there are many reasons. I think monetary policy and interest rate cannot solve every problem, okay? And then like if you have a low interest rate, and definitely it will help people to pay back their debt, and it may make a little more stimulus to the economy. But on the other hand, you have to think about negative side impact. One is that it may end up increasing the asset prices, especially real estate prices. It has a direct impact on the exchange rate. And yes, we can manage it, but if it really depends, environment. If the exchange rate is depreciating quite rapidly, you don't want to put the oil in the fire, right?
BOK Governor Rhee Chang-yong. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight, coming to you live from Bloomberg's new studio here in Mumbai. Now, it is decision day for India's central bank, and most pundits expect the RBI to cut its key rate for the first time in 2 years. The vast majority of economists we surveyed see a 25 basis point reduction, with some backing a jumbo half-point cut, marking a dovish turn under the new governor, Sanjay Malhotra. Here's a look at India assets ahead of that decision. Of course, the rupee front and center. It's hovering close to record lows. The rupee is trading like this ahead of that RBI decision later today. Much anticipation of that 25 basis point cut. Let's get more with our South Asia reporter, economy and government reporter, Anup Roy. Anup, of course, 25 fully priced in.
Yeah, 25 is fully priced in right now, and there are a few in the market and among analysts who are expecting also 50 basis point, but that will put more pressure on the rupee.
Yeah, that is the problem. But if the focus is on growth, then perhaps it needs a bigger cut than what is anticipated in the market.
Yeah, a bigger cut will help in lowering the borrowing cost, but then if the rupee depreciates further, then it will feed into the inflation, and it will become very difficult for the RBI to, keep on the interest rate at a lower base, because then they will have to increase the interest rate soon after.
Realistically, how much of a boost would it give GDP if the RBI were to cut 25 basis points?
So it is difficult to quantify that way. If there is 25 basis point cut followed by a series of cuts, then probably private sector will get encouraged by this and borrow money from the banks and put in fresh investments, and that will lift the economic growth, and also that will help the consumers borrow money to buy cars and home loans, etc., and that will boost the investments.
All right, we'll know soon enough. His decision is coming in just a matter of hours. Bloomberg South Asia economy and government reporter Anup Roy. Let's discuss the impact of a possible RBI cut with our next guest. Nadir Godrej is chairperson at Godrej Industries, which has interests in consumer products, real estate, agriculture, financial services, and chemicals. Good to have you with us.
Thank you.
We've seen that budget adding about $12 billion of liquidity, putting money into the pockets of the middle class. Now it is about monetary policy. How deep should the RBI go?
Yes. Since the budget has been very favorable for growth, I don't think it's necessary for the RBI to go very far. They've already done a lot on increasing liquidity, which of course won't affect the base rate, but it'll affect all other interest rates above the base rate. So that itself is a very good factor. So I think 0.25 should be adequate. I'm not even 100% sure that they will do that.
You're not 100% sure? It's fully priced in.
I'm not 100% sure that they'll do that, and I'm not so sure it's necessary. I'm very worried about the weak rupee because, as your previous speaker said, it can cause inflation, and that's a cause for worry.
If the focus is actually to revive growth, doesn't matter where the rupee is trading. I mean, address the big problem first and then worry about the rupees.
Yes,
later.
But when you wait too long to address inflation, it gets complicated, and already the budget is doing a lot for growth. Consumer products slowed down a bit, but we see that there's a lot of excitement in the market with consumer product stocks because the budget has put a lot of money in the hands of the middle class by changing the tax slabs. Now they are started at a much higher level.
How much of a boost do you think that budget will provide consumption, and how soon do you think it will take?
I think it'll happen very fast. And
What's that? A quarter, 2 quarters?
Yes, a quarter, 2 quarters. Right. And of course, if there is any kind of interest rate cut, that will also help. But then we have to worry about inflation.
How do you see that trickling down into your businesses? Because you're into a lot of the consumer businesses.
That's right. Godrej Consumer Products had a slow quarter ending in December, but now we are expecting that the stimulus will help the economy and help the business and help other consumer product businesses. We also have 2 small food businesses in Godrej Agrovet, and those will also benefit from the stimulus. Plus, there is agricultural stimulus in the budget, and that will help agribusinesses as well, and consumption by farmers.
Can you quantify the kind of boost you're expecting in your earnings? Because like you said, it was disappointing earnings, and that's due to the slowdown in consumption. What kind of a turnaround, what kind of a boost are you expecting?
I think instead of the slowdown, we'll have the normal rates of growth that we have seen in the past.
Do you see any other policy support that's needed to be given by the government?
I think the government has already done a lot in the budget. And in the long run, I think we need a focus on education, skilling. Lots more has to be done that. But that only benefits the economy in the long run. And I think we now need to start thinking about that, because 6 to 7% growth is good. It's higher than the rest of the world. But we need about 9% growth to become a developed country by 2047, as is the government's ambition.
And for that to happen, you need a boost not just for the urban consumers, but also the rural consumers. Currently, the budget targeted the middle class. What kind of trends are you seeing in terms of the rural consumption?
The budget also gave some money for improving agricultural productivity. We don't know how effectively it be put to use, but there's a lot of scope for agricultural productivity increase in India. Certain sectors, such as grape farming, are doing extremely well. Farmers are very prosperous. We ourselves have an oil palm business, and it's all done by smallholders. In the past, smallholders was a big problem in India because they couldn't acquire the necessary skills. But because all our smallholders have a very close connect with us, we provide them with services. We do soil testing, we do geo-mapping, we use artificial intelligence to analyze the satellite pictures, and we give them advice, and the yields have improved. We now have oil palm yields in Andhra Pradesh higher than Malaysia. So that what India lacked in scale, we are making up in network effects. And this is a big potential for agriculture. In other sectors of agriculture, there is not the strong connect between the farmers and industry, but wherever there are farmer-producer organizations or other such entities, we could greatly improve Indian agriculture, make it both more sustainable and with much higher yields, improving farm incomes, and then obviously the farmers will be able to spend.
So given the optimism that you have just expressed, is it fair to assume that you've seen the worst for your consumer businesses?
I think so. I think things will definitely improve. We have seen the worst, but the government has to keep focusing on growth, and if growth stalls, or by stall I mean stays at the 6% level, they need to do some more stimulus.
What stimulus would that be?
I think that any kind of government capital expenditure has been very good in the last few years. It looks like you could have a bigger budget deficit with capital expenditure. But remember, capital expenditure creates assets which have a long life. And any kind of government expenditure that stimulates growth actually improves the debt to GDP ratio. We should focus on expenditures that significantly boost growth because they're a win-win.
But therein lies the dilemma, because the government's trying to rein in its budget deficit to 4.4. I think that is the target for the moment.
And to my mind, the budget deficit shouldn't be the target. Debt to GDP should be the target.
So as long as you're growing, having strong growth?
Faster than the debt.
So we're looking at, what, 8%, 9% growth?
Right, then you can have a bigger budget deficit because debt to GDP will fall.
How optimistic are you that the government will continue to do that? Focus on growth and spending in the process.
In the past, they've done it. There are, in a democracy, there are electoral pressures to spend on short-term gains to win elections. But what's good for the economy is capital expenditure that boosts the economy in the long run.
Let's talk about agriculture. You talked about palm, for instance. We've seen lackluster prices for palm oil. Where do you see that headed?
Actually, palm oil prices have been quite high. And after a long time, palm oil has been at a premium to the soft oils. And in India, we have a 20% import duty currently on oil. So Indian oil prices are good. And so the farmers are quite enthused about palm oil. Some of our user industries, and one of the problems for Godrej Consumer Products was it's a big consumer of palm oil as a raw material. And its competitor, Hindustan Unilever, cut the amount of oil in their soaps. I think in the long run, they may suffer for that action. But right now, they're benefiting because they're using less palm oil. And we are a bit challenged. But we think over time, things will work out. But for our agribusiness, high palm oil prices are very attractive. And our chemical business also uses palm oil and its byproducts as a raw material, but they are able to push through prices to the customer.
So when it comes to prices, are they stabilizing? And if I were to get you to look into the crystal ball to see where prices are headed?
Prices internationally are stabilizing, but Indian prices are likely to keep rising because of the weak rupee.
And what kind of percentage are we looking at?
Whatever the rupee depreciates.
And where do you see the rupee trading?
I think it might depreciate further.
By how much, perhaps?
It won't depreciate forever and ever, but for quite some time it'll depreciate because ever since Trump has come in, his aggressive announcements on trade have affected many other currencies. The dollar is quite strong right now, and I think other currencies are likely to depreciate, which will have an inflationary impact in these countries.
And of course, we heard from Scott Bessent in an exclusive interview with Bloomberg saying that he favors a strong dollar. How concerned are you when you hear the Treasury Secretary of the U.S. saying such a statement?
I think developing countries will have to worry, mainly because their weak currencies will cause inflation unless dollar prices actually start falling. And in India, we are much more dependent on commodity prices, which are internationally determined. In other countries, value added is a big part of the inflation index. In India, commodities and food in particular is 40% of the consumer price index. There will be a readjustment of the consumer price index in which it will fall, because now we are spending less on food than we did in the past. But even that won't be such a big adjustment. So our inflation is very dependent on commodity prices. Other countries' inflation is very dependent on wages.
And Nadir, how should Indian companies be navigating such a complex and increasingly challenging macro environment? How do you thrive in such an environment?
In a difficult environment, there are two ways of approaching it. One is you try to make predictions, which usually don't work. And the second is to be resilient and face the challenges on the go and quickly respond. So responsiveness is a very good solution. And Indians have always been very good. We have a word for this, jugaad. We quickly respond to any new challenge. And for instance, during COVID, we were totally taken by surprise, but we were very quickly able to make a response. And within 15 days, we could keep our factories working in spite of all the challenges because we had the workers live in the factories.
Do you see opportunities to expand, to grow your business despite the current environment?
Yes, we always see opportunity for growth. Yeah. And the Indian economy itself is growing well. And we have global businesses, and currently Godrej Consumer Products' global businesses, which were challenged a little while ago, have been largely set right. We are doing well in Africa, we're doing very well in Indonesia, and even in Latin America we see improvements. So whenever we see challenges, we face them and try and sort them out, and we always see there's a lot of opportunity. And for Indian businesses, another big opportunity is research and development. Indians have been doing too little of it. But now more and more Indian companies are conscious that this is the way to go, and we ourselves are very conscious of that.
When it comes to businesses, you're also in real estate. How is that looking at this point in time?
At this point of time, it's looking good. In the calendar year 24, Godrej Properties was the leader in personal real estate. We are not very active in commercial, though other company, Godrej Fund Management, is in commercial real estate, but it basically runs funds, and Godrej Properties does invest in those funds. But in the retail consumer real estate, we have been doing extremely well, and we were the leader in calendar year 24, and we see this trend continuing at least for some time.
The focus for a lot of people is actually the luxury sector. What kind of growth are you anticipating?
We anticipate good scope in the luxury sector and also in the mid sector. We are also very active in the mid sector.
And given expectations, rate cuts, not just today,
Yes.
But perhaps for the rest of the year, there could be further rate cuts. Might that be an impetus for growth?
That could be an impetus because mortgage costs are very important to the real estate business. And with the current high interest rates, they're high.
You know, we talk about the Indian economy. Some people say that perhaps there is an underestimation of how India is actually intertwined with China's economy. Right now, with the prospects of tariffs on China, there could be a dumping of cheap Chinese products in India. How are you assessing, the relationship between the two economies?
It's a complex relationship. Quite a lot of India's exports have inputs from China. So we have to see on balance what happens. If the Chinese dump things in India and we can add value to them and re-export them, it'll be an opportunity. But we've seen in agrochemicals, competition from China has affected the Indian industry quite a lot. But in other chemicals, we have seen that problems from China or tariffs on China have helped India grow. So we will see both effects, some positive, some negative. But net, we don't think it'll be negative, perhaps a little positive.
Why not? Why that optimism that China will not cause a dent?
Because, as you said, in some areas we are competitors to China, and any challenge to China will help us.
How are you?
There's what they call the China plus one strategy. More and more people are reluctant to depend entirely on China. You see, Apple has suddenly started making phones in India, which they didn't do earlier. They were sourcing entirely out of China. So more and more that will happen. In low-cost products, we face a lot of competition from Vietnam and other Southeast Asian countries. But in high-value-added products or high-technology products, India is the competitor for China.
And that takes us to Modi's manufacturing ambitions. He wanted manufacturing to be 20-30% of GDP. Where are we with that?
I think we're still way behind. Manufacturing is growing fast. But so far, services have been growing even faster. So right now, IT is a little bit challenged, but the GCCs, where foreign companies insource to their Indian operations, are doing very well. So the challenge with getting the manufacturing sector to be a bigger portion of the GDP is that the service sector is always growing fast. And there are certain areas of the manufacturing sector which use high-tech or R&D and things like that, which are doing well in India. But the service sector also does very well in India. So I feel that both will grow, but the proportions may not change much.
Now that we know that Prime Minister Modi is headed to Washington, D.C. to speak to President Trump, how do you think that will play out? I mean, what are you hoping to hear or see?
Right. So we've seen that Trump has already shaken down Mexico and Canada, and he'll probably try and shake down Modi as well. And in the case of Mexico and Canada, they didn't make huge concessions. And what I expect is that Prime Minister Modi will also not make huge concessions, and Trump will claim it's a victory, and India won't be too badly hurt.
Hey, Nadir, thank you so much for that. Nadir Godrej, Chairperson at Godrej Industries Group. Of course, it is a big day for India. It is decision day for the RBI. The new central bank governor, Sanjay Malhotra, hugely expected to cut rates by 25 basis points after the RBI stood pat for about 2 years. Taking a look where the markets are right now, under slight pressure. The Sensex currently down about 1/10%, losses too. For the other benchmarks. The Indian rupee, 87.4625, currently down about 1/10%. No, actually, it's up by about 1/10% versus the USD. The USD, by the way, flat as we speak. Coming up on Insight, boosting India's soft power through arts. More from my conversation with Ambani Foundation Chair Nita Ambani just ahead. Keep it here with us. This is Bloomberg. Welcome back to Insight, live from Bloomberg's news studio in Mumbai. The city is known as a financial capital, but it's also playing a significant role in promoting India's soft power. Nita Ambani's Cultural Centre has brought big Broadway and West End shows here for the first time. She told me more about how art and artists are raising India's global profile.
India has such a great history. If we take that legacy and ensure that it is nurtured, it is cherished, so that it lives on for generations to come, I think that would be our vision, to shine the spotlight on India.
So it is about India on the global stage. It's also about bringing the world to India.
When we started the center, we said the best of India and the best of world will come here. You know, I get inspired and motivated every day when I speak to all the artists and the kind of stories that they tell me. In 2015, I was visiting Rajasthan as a part of a Reliance Foundation project. And there I happened to meet these artists, and most of them had learned their art at the feet of their grandfathers, great-grandfathers. But they were all giving up the lineage of art and taking up jobs like sewage cleaners, bricklayers, because there was no sustenance, no livelihood in the art form. So I think art is meant to be inclusive. It is meant to inspire everyone, and everyone has the ability to create their own art, appreciate art, and bring it to the world.
Reliance Foundation founder and chair Nita Ambani. And that's just a taste of our wide-ranging conversation. You can catch it in full on the latest episode of Latitude, which premieres on February 13th on Bloomberg Television and, of course, on our YouTube channel. Subscribers can also watch on the terminal. Do catch that episode. And here's a look at what's coming up next on Insight on Tuesday. Join us for an exclusive interview with Mahindra Group CEO Anish Shah as we discuss growth opportunities in India. And we're at India Energy Week with guests including Oil India Chair Ranjit Rath and LanzaTech CEO Jennifer Holmgren, plus Merit International's Rajiv Menon will be joining us on Wednesday to talk Asian consumption trends, leaving you with how Asian benchmarks are looking as we await the jobs data out of the U.S. that may just dictate the Fed's monetary trajectory. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.